Here's a sentence that sounds backwards, but it's the entire industry compressed into one line. You don't buy a cargo ship to move cargo. You buy it to sell the steel later. For a huge share of owners in this business, the freight moving inside the ship was never the real profit center. The real profit is the resale value of the hull itself. And here's the number that should genuinely surprise you. A 5-year-old ship can sell for almost as much as a brand new one. Think about how strange that is. Try selling a 5-year-old car for nearly the price of a new one. It doesn't happen. Try selling a 5-year-old house for what a brand new one costs, in the same neighborhood with none of the wear and tear priced in. It doesn't happen there either. But in shipping, the asset cycle, buying low, selling high on the steel itself, can matter more than the cargo cycle ever does. Today we're breaking down the real economics of owning a cargo ship, because underneath the containers and the cranes, this is a business built on asset speculation, hidden ownership structures, sanctions evading shadow fleets, and a debt cycle that can create billionaires one year and bankruptcies the next. By the time we're done, you'll understand why a ship's paint job might be the least honest thing about it, and why the person steering it from the bridge might have less control over its fate than a banker sitting in an office thousands of miles away. Let's start with the fact that breaks how most people think about depreciation entirely. Unlike cars or houses, second-hand cargo ships often trade at 80 to 90% of new-build prices, and during genuinely hot markets, sometimes even closer than that. Why would a used version of anything sell for nearly the same price as a brand new one? Because new shipyard slots are completely full, often years in advance, and ordering a new vessel today means waiting 3, 4, sometimes 5 years for delivery. If you need shipping capacity right now, and the alternative is waiting years for a new build to be finished, a used ship sitting ready to sail today becomes almost as valuable as one that doesn't exist yet. This single dynamic completely inverts the normal logic of depreciation that governs almost every other physical asset. In most industries, age destroys value predictably and steadily. A car loses a chunk of its value the moment it's driven off the lot, and keeps losing value every year after that, on a fairly reliable curve. In shipping, during the right market conditions, the ability to deliver capacity immediately can matter more than how many years the vessel has already been sailing, how many nautical miles are on its hull, or how close it is to needing its next major overhaul. This is also why shipping owners think about their fleets less like a collection of aging machines and more like a portfolio of assets whose value can rise or fall dramatically based purely on shipyard capacity and delivery timelines elsewhere in the world. Variables that have nothing to do with the condition of the specific ship they happen to own. Here's a structural reality that surprises people who assume the company logo painted on the hull tells you who actually owns the vessel. It very often doesn't. Owners frequently rent out the physical ship itself on what's called a time charter, while the operator running day-to-day voyages, the crew manager staffing it, the insurer covering it, and the legal owner holding the actual asset can all be 4 completely different entities, none of whom necessarily have any relationship with each other beyond a stack of contracts. The name painted proudly on the side of the hull is often just a brand identity, not the deed holder, not the party bearing the financial risk, and not necessarily even the party making the operational decisions. This means when you see a famous shipping company's name gliding past on a massive vessel entering a port, you're frequently looking at a ship that company doesn't even own. They're simply chartering capacity from someone else entirely, an owner whose name never appears anywhere the public can see, who might hold a single ship through a purpose-built holding company, or who might operate a fleet of dozens of vessels chartered out to a dozen different well-known shipping brands simultaneously. Think about how unusual this layering actually is compared to almost any other consumer-facing industry. When you see an airline's name on a plane, that airline usually operates the plane directly, even if a leasing company technically owns it. When you see a hotel chain's name on a building, there's a real operational relationship there. In shipping, the layering runs deeper. The brand you recognize, the company actually running the voyage, and the entity legally holding the vessel can all be separated by multiple contractual walls, each one existing specifically to isolate risk, financing, and liability from the others. The ship itself is best understood as a piece of inventory being moved between these layers, not the core identity of any single business you could point to. Here's a cost structure that exists whether or not a single container ever gets loaded. Fixed operating costs. A mid-size cargo ship burns through roughly $7,000 to $12,000 per day in fixed operating costs alone: crew salaries, insurance premiums, ongoing maintenance, and administrative overhead. And this is all before a single dollar is spent on fuel or port charges. The ship could be sitting completely still, anchored offshore with zero cargo aboard, waiting for a charter to materialize or waiting out a slow market, and this daily bill keeps accumulating regardless of what's happening around it. This is exactly why idle time is so financially dangerous in this industry, in a way that's genuinely different from most other capital-intensive businesses. A ship isn't like an empty warehouse quietly waiting for inventory to arrive, generating no cost beyond a modest lease payment. It's actively consuming thousands of dollars every single day it exists. Crew still needs paying whether or not the ship is working, insurance premiums don't pause, and scheduled maintenance windows don't wait for a more convenient, cash flow positive moment to happen. Multiply that daily figure across a full year, and you start to see why owners are so sensitive to utilization rates. A ship sitting idle for even a few months isn't a neutral pause, it's a direct cash outflow in the tens or hundreds of thousands of dollars on an asset that was specifically built to be moving, earning revenue almost constantly. Idle capacity in shipping doesn't quietly wait. It actively bleeds money the entire time it isn't working. Here's a fact that reframes how you should think about the giants of this industry. The largest shipping lines in the world frequently avoid owning their entire fleet outright. Major global carriers lease a substantial share of their capacity to keep balance sheets lean, rather than tying up enormous amounts of capital in vessels they hold directly on their own books. The actual legal owners behind that leased capacity are frequently Greek shipping families with generational expertise in vessel ownership, private equity funds looking for a specific kind of asset-backed return, or specialized single-vessel holding companies structured to own literally one ship each. Entities most passengers, and even most people working in adjacent industries, have genuinely never heard of. This creates a genuinely strange structure sitting at the top of an industry most people assume is dominated entirely by a handful of famous shipping brands. The household names people associate with global shipping are often closer to logistics and scheduling operators renting capacity as needed, while a quieter, far less visible layer of specialized owners actually holds the physical assets underneath the entire system, collecting charter payments regardless of which brand happens to be using the ship that particular year. This division of labor exists for good reason. It lets the famous operating companies scale their capacity up or down flexibly as global trade shifts, without permanently committing hundreds of millions of dollars to ships they might not need in 5 years. Meanwhile, it lets the specialized owners focus purely on what they do best: buying, financing, and eventually reselling vessels at the right point in the asset cycle, without needing to run an actual shipping line, sell cargo space, or manage customer relationships at all. Here's a detail that surprises people who assume offshore registration is purely about hiding ownership from public view. Many vessels are registered under flags specifically because those jurisdictions tax tonnage, meaning the physical size of the ship, rather than taxing income or profit generated by the voyages themselves. This single structural choice turns what would otherwise be a genuinely volatile, unpredictable trading business into something closer to a predictable, low-tax asset play. Instead of paying tax based on how profitable a given voyage or a given year happened to be, an owner pays a comparatively stable, predictable tax tied to the ship's physical dimensions, its gross tonnage, regardless of whether that specific year was a boom or a bust in the broader freight market. This is precisely why so much of global shipping ownership flows through flags and jurisdictions most passengers have never heard of, and never think to ask about when they see a ship's home port painted on its stern. It's not necessarily about hiding who owns what from regulators or the public, although in some cases it certainly can serve that purpose too. It's that the tax structure itself fundamentally changes the economics of owning the underlying asset, turning a business with genuinely wild year-to-year swings in profitability into something an owner can plan around with far more confidence, purely by choosing where the vessel is legally registered. Here's where this industry connects directly to global commodity markets in a way most people never consider. At the end of a ship's operating life, its value is largely determined by its steel weight, not by its remaining shipping capability. A spike in global scrap steel prices can turn an aging, otherwise unremarkable fleet into a genuine goldmine, simply because the raw material sitting inside every hull suddenly becomes significantly more valuable on the open commodity market. A crash in scrap prices, on the other hand, can strand owners with assets that are literally worth less as scrap than the debt still owed against them, meaning the ship becomes a liability to dispose of rather than an asset to cash in, even though physically nothing about the vessel itself has changed. This means every ship ever built is quietly running two separate economic clocks simultaneously for its entire operating life, one measuring its earning potential as a working vessel carrying cargo and generating charter income, and another tracking its eventual value as a pile of scrap steel sold by weight to a recycling yard. Depending purely on the timing of global commodity cycles, that second clock, the one almost nobody outside the industry ever thinks about, can end up mattering more to an owner's final return than the first one ever did across the ship's entire working career. Here's the volatility that defines this entire industry more than almost any other factor. During supercycle booms, top shipping owners have posted multi-billion-dollar profits in a single calendar year, profits that would look more at home in a technology company's earnings report than a business moving steel boxes across open water. During busts, that exact same leverage that created enormous wealth can force mass bankruptcies across the industry almost simultaneously, as multiple owners who all borrowed heavily during the good years suddenly find themselves unable to service that debt when freight rates collapse. It's the same underlying business, often the same fleets, sometimes even the same individual owners moving between fortune and collapse within a single decade. The only variable that changed is where global trade happened to sit in its cycle at that particular moment in time. This is precisely why shipping has a long-standing reputation, going back generations, as one of the most boom and bust-prone industries in the entire global economy, arguably more volatile than oil, more volatile than airlines, and rivaled only by a handful of other deeply cyclical, capital-intensive sectors. The swings aren't occasional anomalies that catch the industry off guard. They're a structural, recurring feature of how this business has always operated, baked into the fundamental mismatch between how quickly new ships can be ordered versus how quickly global trade demand can shift. Here's a genuinely unsettling layer of this industry most people have never heard of: the shadow fleet. Roughly 17% of the world's oil tankers now operate in what's essentially a semi-illegal shadow fleet. Older vessels with vague, deliberately obscured ownership structures and minimal, sometimes non-existent insurance coverage, moving sanctioned oil around the world outside the normal regulated shipping system that most of the industry operates within. This isn't a fringe curiosity affecting a handful of rogue vessels tucked away in some forgotten corner of global trade. Nearly 1 in 5 oil tankers on the planet right now is operating in this shadow layer, a genuinely massive, semi-hidden segment of global energy trade running parallel to the legitimate shipping industry most people picture when they think about how oil actually moves around the world from producer to buyer. Think about the scale of what that number actually represents. This isn't a handful of sanctioned vessels slipping through gaps in enforcement. It's a structurally significant portion of an entire category of global shipping, operating with older ships that would likely fail inspection in a normal regulated market, carrying insurance that may not actually pay out in the event of a genuine accident or spill, and moving oil that Western sanctions was specifically designed to keep off the open market. This shadow layer exists at a scale large enough that it now meaningfully affects global oil supply calculations, tanker availability in the legitimate market, and insurance pricing for the entire tanker industry, legitimate and shadow alike. Here's why this shadow fleet exists in the first place. Western oil sanctions on countries like Russia, Iran, and Venezuela didn't eliminate their ability to sell oil onto the world market. They pushed that trade into a vast underground shipping economy instead, one sophisticated enough to route around the very restrictions designed to stop it. This underground system now runs on ship-to-ship transfers conducted quietly at sea, often in international waters far from any port authority's direct oversight, deliberate spoofing of automatic identification, tracking signals to hide a vessel's true location and route, and fabricated documentation designed to obscure where cargo actually originated before it reaches its final buyer. Sanctions, in other words, didn't kill this trade, they industrialized it, creating a permanent, increasingly sophisticated infrastructure specifically built to move sanctioned goods around the very restrictions meant to prevent that movement entirely. This creates lasting risks that extend well beyond the immediate geopolitics of any single sanctions regime. These older, minimally insured vessels operating outside normal regulatory oversight represent genuine safety and environmental hazards, quietly floating around the world's oceans with none of the standard protections that legitimate, properly insured shipping requires. A serious accident involving one of these vessels, a collision, a spill, a structural failure on an aging hull that hasn't seen proper maintenance, could produce an environmental disaster with essentially no insurance backing to fund the cleanup, because the entire point of the shadow fleet structure is to minimize exactly that kind of accountability. Here's a fact that separates shipping from almost every other business we've covered on this channel. An owner's single biggest financial risk isn't fuel, and it isn't even the crew or maintenance costs we covered earlier. It's the freight rate cycle itself, and owners have essentially no meaningful ability to control it. Freight rates swing wildly based on global trade volumes, geopolitical tensions in key trading regions, and physical disruptions at critical choke points like the Suez and Hormuz canals. Narrow waterways where a single blockage, conflict, or drought-driven restriction can instantly reroute a meaningful share of global shipping capacity and send rates soaring or collapsing within days. Individual owners can't set their own prices in any meaningful way, the way a manufacturer might adjust pricing based on their own costs. They simply ride whatever the broader market happens to be doing at that exact moment, and that market has absolutely no regard whatsoever for any individual owner's debt repayment schedule. This is a genuinely unusual position for a capital-intensive business to be in, and it's worth sitting with how strange it actually is. You've committed hundreds of millions of dollars to a physical asset with a decades-long working life, financed largely through debt that requires steady, predictable payments, and the single most important variable determining whether that enormous bet ultimately pays off, the price you can actually charge to move cargo on any given voyage, is almost entirely outside your control. Set by forces as far removed as a canal drought on the other side of the world, or a geopolitical flashpoint you had no way of predicting when you first ordered the ship. Here's why leverage plays such an outsized role in this industry's most dramatic outcomes, both the spectacular successes and the sudden collapses. High debt amplifies both gains and losses to an extreme degree, far beyond what you'd see in less capital-intensive businesses. In upcycles, borrowed money supercharges returns. An owner using significant leverage to finance their fleet can turn a good market into an extraordinary one, since the gains from rising freight rates flow disproportionately to the equity holder once the fixed debt service is covered, effectively letting the lender's capital do a huge share of the work, while the owner captures most of the upside. But in down cycles, that exact same debt structure can sink companies that still technically have full ships actively carrying cargo around the world, generating real revenue, but that no longer generate enough cash flow to cover the debt payments that were sized for a much stronger market. This is precisely why some shipping collapses feel so jarring and confusing from the outside, even to people who follow the industry somewhat closely. A company can be operating a fully utilized fleet, genuinely moving cargo profitably in an operational sense, with ships sailing full and on schedule, and still be forced into bankruptcy purely because the debt taken on during better times no longer matches the revenue the current market is producing. The ships didn't stop working. The market simply stopped paying enough to service the bet that was placed on it years earlier. Here's a live, industry-wide gamble playing out right now, in real time, across the entire global fleet. New international emissions regulations are forcing ship owners into a genuinely difficult choice between expensive retrofits to existing vessels, adopting entirely new alternative fuels that may or may not become the industry standard, or risking that their existing vessels become uneconomical to operate before reaching the end of their typical 25-year working life. This isn't a minor compliance detail buried in a regulatory filing somewhere. Across the entire global fleet, this represents a decision point worth well over $1 trillion collectively, every single owner, across every category of vessel, effectively placing a bet on which fuel technology, which retrofit approach, or which alternative pathway will actually make economic sense over the coming decades, without any of them having certainty about which direction the rest of the industry, the regulators, and the fuel supply infrastructure will ultimately settle. Guess wrong on this bet, and an owner risks holding a fleet of what the industry bluntly calls stranded assets, vessels that are technically still perfectly seaworthy, structurally sound, and capable of carrying cargo, but economically obsolete years before their physical hulls would otherwise need retiring, because they can no longer meet emissions requirements profitably, or because the fuel they were built to run on has become prohibitively expensive or simply unavailable at the scale the industry needs. Let's put a real number behind the physical asset itself. Large container ships and LNG carriers routinely cost well over $150 to $200 million to build, comfortably more than a commercial passenger airliner, and in some cases approaching the cost of a small regional airport's entire infrastructure. And yet, as we covered earlier, the company logo painted proudly on the side of that multi-hundred-million-dollar vessel often doesn't represent the actual legal owner at all. You could be looking at one of the most expensive moving objects human engineering has ever produced, built by one company in a shipyard on the other side of the world, financed by a completely separate bank or investment fund, insured by a third specialized maritime insurer, and branded with the name of a fourth party that's simply chartering its use for a few years before handing it back or moving on to a newer vessel. This layering isn't unusual or suspicious in this industry. It's simply how the business has always structured its capital and risk, spreading exposure across multiple specialized parties rather than concentrating it all in one place. But it does mean that almost nothing about a ship's visible branding, the flag on its stern, or the name painted across its hull tells you anything reliable about who's actually financially exposed to it, who profits when it performs well, and who absorbs the loss if it doesn't. Here's a detail that reframes the entire chain of command in this industry and genuinely surprises people who picture a ship's captain as the ultimate authority over every decision made on board. Key operational decisions, speed, routing, even maintenance scheduling, are frequently dictated by finance teams and lenders chasing optimal fuel costs and charter rate economics, not by the ship's actual master standing on the bridge making independent judgment calls. The romantic image of a weathered, experienced captain making seasoned decisions about how best to run their vessel based purely on seamanship and conditions at sea is, in practice, heavily constrained by financial decisions made in an office thousands of miles away. Decisions driven by people optimizing for bunker fuel costs, charter rate targets, and financing covenants, rather than pure maritime expertise. A captain might have the authority to make an emergency call in a genuine crisis, but the routine, day-to-day economic decisions that determine how the ship actually operates over the course of a voyage are frequently set well before the ship even leaves port. This is a genuinely important thing to understand about how modern shipping actually operates beneath its traditional seafaring image. The person with the most visible authority on the ship itself, the one wearing the uniform and standing on the bridge, often has meaningfully less control over the vessel's core economic decisions than the finance team and lenders sitting comfortably onshore, tracking fuel prices and charter markets on a screen far removed from the ocean itself. Here's a risk that lives entirely outside a ship owner's control, and that most people only became aware of during recent global supply chain disruptions: port congestion. A ship can be perfectly built, perfectly financed, perfectly crewed, and still generate zero revenue for weeks at a time simply because it's stuck waiting outside a congested port with dozens of other vessels, unable to unload its cargo or take on a new charter. During periods of severe global disruption, container shortages and port bottlenecks have stranded enormous amounts of shipping capacity essentially idle, not because the ships themselves had any problem, but because the physical infrastructure on land simply couldn't process them fast enough. This is a genuinely underappreciated risk category in this industry. An owner can do everything right, buy the right ship at the right price, secure a solid charter, staff it properly, and still watch weeks of potential earnings evaporate because of a bottleneck happening entirely outside their control, on land, at a port they don't own and can't influence. It's a reminder that a cargo ship's economics don't just depend on the open ocean and the freight market. They depend just as much on the health of the entire global logistics chain the ship is plugged into, including the parts an owner has zero ability to manage directly. So let's go back to where we started. You don't really buy a cargo ship to move cargo. You buy it as a financial instrument, one that happens to be extremely good at moving cargo along the way, but whose real value lives in the asset cycle, the debt structure, and eventually the steel itself. Every strange detail in this industry traces back to that same root idea: the used ship worth nearly as much as new, because delivery timing matters more than depreciation. The tangled ownership layers because the vessel is inventory, not the business itself. The shadow fleet, because sanctions didn't remove demand, they simply pushed it underground. The debt-fueled booms and busts, because leverage amplifies whatever the freight cycle happens to be doing in either direction. Even the ports themselves, sitting entirely outside an owner's control, can decide whether a perfectly good ship earns anything at all in a given month. This is exactly the kind of industry this channel exists to take apart, something that looks like a simple, physical business moving goods around the world, and turns out to be a complex web of asset speculation, hidden ownership, geopolitics, and financial engineering, all wearing a shipping container as a disguise. If this changed how you think about the next cargo ship you see gliding past a port, subscribe, because we're just getting started pulling apart the businesses hiding behind the headlines. See you in the next one.